You're listening to Puma Podcast.
And if the peso falls, our imports become more expensive. If our imports become more expensive, whether it's final goods like rice or imported components like energy, like oil, the more reliant we are on imports, the worse actually the effect on domestic prices from a fall in the peso.
Hi, I'm Tatiana Maligro, Puma Podcast, and you're listening to Teka Teka. In the last few weeks, bumagsak ang peso. It's at an 18-month low exchange rate versus the US dollar. What does this mean? And is it time for the government to intervene? On May 21, the peso fell to the 58 level versus the dollar. This is the lowest it's been in nearly 2 years, since it was at 58.20 in November 2022. We weren't alone though. The Philippine peso is just one of the currencies that weakened. The US Federal Reserve hinted at delays in lowering interest rates, so this led to the movements in currency exchange rates. US market movement is just one factor that determines the strength of the peso versus the dollar. But what other factors affect the foreign exchange rate anyway? Sonny Africa, executive director of think tank Ibon Foundation, says foreign exchange rates are affected by supply and demand.
Ultimately, the foreign exchange rate is really most of all about yung supply and demand of pesos and dollars relative to each other. So the more a currency is demanded, like the more the dollar is demanded, the higher its price, and conversely, the stronger supposedly it becomes and the weaker the peso becomes regarding that.
So if the current peso dollar exchange rate is bad for us, what does a healthy exchange rate look like? Sonny says there's no correct answer.
I think it'd be very hard to say that there is a peso dollar exchange rate that is the sign of a healthy peso. One, there's always going to be volatility between the peso and the dollar, not just because of what happens in the Philippines, but because of what happens in the US. It's also vulnerable to their own financial crises, also vulnerable to their own effects of their own industrial policy, vis-a-vis China, all of that. Secondly, actually, whether the peso is strong or weak and whether it's beneficial or not, it's not universal. Because, for instance, strong peso can actually make imports cheaper. And if imports are cheaper, it potentially makes production and the sale of goods, imported goods in the Philippines, also cheaper. At the same time, a strong peso would make our exports more difficult kasi our products will be more expensive abroad. Our products are overseas workers. So there's that dynamic, parang may bigay bawi na factor happening. Third, that's why it's so hard to find one particular number. What is the best peso won't be the same in the 1950s or 60s under a fixed exchange rate with the sort of Philippine economy we had, vis-a-vis the other our ASEAN neighbors. It's going to be different from the peso that might be most valid now in 2024, 2025, 2026. So parang the economic conditions globally and locally will be so different.
So there's no peso dollar rate that's objectively strong or weak, since there are so many factors that determine the forex. But when the peso falls to lower levels like it has in the last 2 weeks, it is a reason for concern. The exchange rate doesn't just impact a country's international trade, it's also a reflection of the health of a country's economy. As of June 4, the Philippine peso has yet to recover. It closed at 58 pesos and 70 centavos versus the dollar. Sonny says the Philippine peso wasn't always this weak against the dollar. Back in the 60s, the exchange rate hovered at around 3 to 4 pesos versus the US dollar. But the peso weakened significantly during Ferdinand Marcos Sr.'s regime because of increasing foreign debt. By the time Marcos Sr. was ousted in 1986, the peso was 80% weaker than it was when he took office. And the peso continued to weaken as the new government began restructuring the economy to service the $26 billion debt he left behind. Since then, the peso has continued what's called chronic devaluation. Sure, market movements determine what the foreign exchange rate will be, But Sonny says this long-term depreciation can be attributed to one fundamental cause. We're not earning enough from our exports, and we're relying too heavily on imports.
Even if the interest rates in the US will go down, which they will in a few months or in a couple of years, the peso won't become any stronger because the fundamental problem of we're not earning enough from exporting, producing exports or producing cheap labor to earn all the dollars we need to pay for our imports. And that's super problematic kasi kumbaga, we're caught in a bind. If we're not earning enough dollars from our own production, it means we become more reliant on imports. But the more reliant we are on imports, the more vulnerable we are to the peso falling.
The Philippines' trade deficit, or the difference between the values of the country's imports and exports, narrowed to just $3.18 billion in the first quarter of the year. In the same period last year, we were importing $11.2 billion more than we were exporting. However, the Philippines' slimmer trade gap was not good news for us. The Philippine Statistics Authority said our trade gap narrowed because of a decrease in overall market activity. In other words, we were importing and exporting less goods in general. And even then, importing goods still comprised around 60% of the Philippines' trade activity during that time period. Apart from exports, the Philippines also relied on OFW remittances to bring in dollars. But Sonny points out that even remittances have seen a slower growth rate over the years.
The Philippines will keep relying on exporting kanyang cheap labor sa OFWs. But even that has reached a point na Yung the good times of nung 1990s, 2000s in terms of double-digit increase in forex remittances, wala na yun Like we're treading literally 1, 2, 3% a year na lang ngayon. So any forex observer will see the Philippines is not going to be generating enough dollars from its exported labor. It's not producing anything to sell abroad kasi nga nag-hollow out na yung manufacturing natin.
In February, the Bangko Sentral ng Pilipinas reported that OFW remittances only grew 3%. Economists often say OFWs and exporters can benefit from a weaker peso, since it makes Philippine-made goods more attractive. The stronger dollar can also give families of OFWs more purchasing power. But with a weaker peso also comes quicker inflation. And this means the cost of goods will continue to rise at a faster rate.
Real wages right now across all regions are lower than they were than in 1989. So that's real wages. So if inflation keeps going up and then business resists higher wages, that only means real wages are going to fall even lower. And even lower real wages means even less consumption for ordinary workers, dragging down even the informal sector kasi so much of the informal sector is producing wage goods for workers. As it is now, household consumption is slowing. That's going to fall even lower. If household consumption over 70% of the economy also falls, that also means jobs will be affected, incomes will be affected. Magkaka-vicious spiral tayo. I don't know how exactly that will play out and when. Pero clearly, if the peso keeps falling, prices are going to become more expensive, jobs are going to be scarcer, incomes are going to be lower.
The peso's chronic depreciation puts the Philippine economy in the cycle. If we're not earning enough from exports, we need to import more goods. But if we need to import more goods, then the cost of basic commodities will go up. And when inflation quickens, the government needs to import more to stabilize prices. You get the picture. We're already seeing the cycle at play. Last week, the BSP said it is expecting a higher inflation print in May because of the weaker forex rate. With a need to keep the inflation rate down, the government also announced that it is halving tariff rates for rice. Economists believe that this will make rice cheaper in the short term, but it will leave Filipino farmers struggling to compete. So what does the Philippine government need to do to stop the peso's continuous depreciation? More on that after a short break. The Philippines' dependence on imports and lack of earnings from exports is placing its currency under constant pressure. Despite this, the BSP sees no need to intervene. It did vow to take steps, if needed, to ease the volatility of the forex market. But it sees the weaker peso dollar exchange rate as a result of hopes that the US will cut its interest rates in the near future. And once it does just that, everything will go back to normal. Ibon Foundation's executive director, Sonny Africa, acknowledges that leaving the forex rate to the markets is often the textbook way to go. After all, we just don't have enough foreign exchange reserves to beat the market. But this doesn't mean the Philippines is entirely helpless in this situation.
The mid 1990s, and especially after I think 2002, when the Bangko Sentral officially took on inflation targeting as its main approach, leaving everything to the market is a default mode. So there's a germ of truth doon because we will never have enough foreign exchange reserves to beat the market. Totoo yun. Even our acclaimed, we can have relative life foreign reserves. I mean, yung 7-8 months natin ngayon, comparatively with our regional partners, is actually quite high. Some are like 3, 4, 5 months worth na lang. So despite having among the biggest foreign exchange reserves based on needs sa region, there's no way that all of that will be enough to fight with the market. If the government does two things, shows a decisive measure na we will intervene to protect the peso up to a point, and then also show na we will intervene to lessen our dependence on imports and lower the pressure on the peso to the extent na naniniwala na that markets are rational, they'll factor that in. But the thing is right now, it's very clear. The government is not intent on boosting domestic agriculture productivity.
Sonny believes strengthening the peso requires the government to initiate long-term reforms. And it can start by boosting agricultural production and the productivity of other local industries.
Kailangan may kaakibat nga na real commitment to improve agriculture industry. At the same time, because it takes time for food to become cheaper and for firms to set up and produce for the local economy, you need ayuda. You need emergency assistance for the poorest households. So parang you need that boost to household purchasing power as well.
Improving economic activity does not only improve the peso's standing in the forex market, it also creates more high-quality jobs for Filipinos and boosts our incomes. It even makes our economy less vulnerable to fluctuations in the market. Strengthening the peso in the long term will not happen overnight. But if the Philippines takes these baby steps towards long-term reforms, it sends a message to the global financial market that it will defend the peso from market volatility, and it is willing to get its hands dirty to do so.
Sinasabi nila ASEAN is the center of economic growth in the world today because Asia. Let's wield it as leverage na if foreign financial markets still want to keep investing in our region, if they still want to keep operating, may trade-off. Don't let us just follow blindly yung dictates of global financial capital. Let us regulate financial flows. In exchange, you can invest here. But yun nga, tama yun. No single country can do that. Talking to other ASEAN governments, uy, pagtulungan natin to. And there's no way around it. Parang either you get stuck with the way things are, or you take the effort to change the way things are. And yun nga, may self-fulfilling logic yung behavior ng Bangko Sentral because that's normal. That's taught in textbooks, and that's the way the global financial system works. But if you don't advocate to change that global financial system, and then you'll be stuck talaga mechanically doing what textbooks tell you to do. And we'll be where we are right now, market-determined underdevelopment, market-determined poverty, market-determined poor agriculture, poor industrial outcomes, which I don't think should be our normal.
And that was today's episode of Teka Teka. We hope that this episode painted a clear picture of the weaker peso's impact on our daily life. If you know someone who works abroad or wonders what it means when the peso goes up and down, please share this episode with them. Again, I'm Tatiana Malicro. This episode was edited by Pidoy Blanco. Our Teka Teka executive producer is Jill Caro, and our editor-in-chief is Carl Javier. And of course, don't forget to follow Teka Teka and Puma Podcast on your favorite podcast app or on YouTube. Thanks for listening.